given the rumpus in America over President Trump's firing of the head of the Bureau of Labor Statistics over the unemployment data, the White House's ongoing efforts to influence US Federal Reserve policy, and Fed Chair Jay Powell's apparent pivot at the Jackson Hole Symposium's world cutting interest rates in September, the biggest news item of this week coming is likely to be the latest round of US jobs, unemployment and wage growth data on Friday the 5th of September. Remember to watch not just the headline figure for August, compared to July's edition of just 73,000 new jobs, but also any revisions to the earlier estimates for both June and July. Upward revisions generally bode well for the economic outlook. Downward revisions tend to speak of a slowdown, and the trend of late has been down, not up. Corporate news flow may still be in a bit of a lull, even as the summer holidays draw to a close, but there's quite a varied slate of UK corporate results for the coming week in terms of companies and industries. Names to note and research further may include the following: Kainos on Monday the 1st of September, Oxford Nanopore, Johnson Service, Ashtead on the 2nd, M&G, Hilton Food, Bakkavor and NCC on the 3rd, Genus, Funding Circle and Safestore on the 4th, and Ashmore on Friday the 5th. We're going to focus on three of those, Ashtead and then the two fund management groups, M&G and Ashmore. After a big rally from spring's lows, Ashtead shares are broadly unchanged from a year ago and indeed compared to 4 years ago. This is interesting given how the equipment rental hire business gets some 90% of sales and profits from North America, where the common perception is the economy remains in decent health, even if those disputed US jobs numbers from the Bureau of Labor Statistics may be starting to suggest otherwise. Indeed, for the full year to April 2025, Ashtead showed a second consecutive drop in annual profits and announced a planned second straight cut in capital expenditure on new equipment, to again perhaps imply the outlook's not as clear as many would like to think. The first quarter update to the end of July is likely to be benchmarked against the guidance given for the full year to April 2026 by Chief Executive Brendan Hogan back in June alongside the 2025 results, namely rental revenue growth of between 0 and 4% compared to 4% last year, gross capital equipment on new kit of between $1.8 and $2.2 billion, down from $2.4 billion, and free cash flow of between $2 and $2.3 billion, up from last year's $1.8 billion. Next, we turn our attention to M&G. Despite all the doom and gloom that surrounds UK equities, value-oriented strategies and active fund management more generally, shares in M&G stand at an all-time high, just under 6 years since the FTSE 100 index member was spun out of Prudential. Key figures to note in these first half figures for 2025 will include net inflows or outflows of assets. After 2024's net outflow of £1.9 billion, the left total assets at £346 billion. Progress in the £230 million cost-cutting reduction programme, and growth in adjusted operating profit relative to management's goal of an average growth rate of 5% or more for the 3 years to 2027. Ultimately, the dividend, where consensus forecasts are looking for a 3% growth for 2025 as a whole. The interim payment a year ago was 6.6p a share. Note that if the analyst consensus estimate the full year divvy of 20.6p a share is correct, that would put M&G on a forward dividend yield of just below 8%, the fourth highest forecast yield within the FTSE 100 for this year. Finally, we turn to another fund manager, this time Ashmore, whose full year results at the end of June are due on the 5th. M&G's value style has not necessarily been in vogue for some time, and Ashmore's area of expertise, emerging markets, has been overshadowed for a good decade and more by investors' preference for American assets. However, market watchers may have noticed how emerging market equities are starting to make a bit of a go of it, perhaps helped by a weaker dollar, hopes for more stimulus from Beijing for the Chinese economy, and the yawning valuation gap between these developing arenas and America. It'll be interesting to see if emerging markets' improved performance across equities and fixed income starts to drive any positive fund flows towards Ashmore, whose last trading statement flagged total assets under management of $47.6 billion at the end of June. Besides fund flows, analysts will look at fee growth, cost management and ultimately the dividend. Ashmore kept its interim payment unchanged at 4.8p a share, and an unchanged final payment will take the total for the year to 16.9p, enough for a dividend yield of 9.5%. That fat figure reflects the extra compensation investors are demanding as a result of the risks to the business model that they perceive, although some income seekers may be reassured by the big cash pile, which represents around a third of the company's stock market capitalisation and covers the cash dividend payments 3 times over. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.